the European Central Bank put out a report talking about Bitcoin, which I found very interesting, and I will be sharing a few points, a few takeaways that I thought were amazing coming from our friendly central bankers over there at the ECB, who are, of course, looking out for everyone's best interests. So dive in with me, subscribe to the channel if you're into Bitcoin, particularly Bitcoin mining, and if you want to keep up to date on these types of issues. I think the European Central Bank and other central banks are the ones actually causing the disparity in wealth, and it's not Bitcoin, it's central banking that's the problem. So this paper is called The Distributional Consequences of Bitcoin. I highlighted a few points, and it starts off by saying that Bitcoin does not increase the productive potential of the economy, and it impoverishes, they argue, non-holders and latecomers in Bitcoin. And they look at this argument from the perspective of Bitcoin continuing to go up, which is very interesting as a Bitcoiner to look at a central bank's comments on if Bitcoin does what we think it's going to do and what that means for humanity. Holders of Bitcoin and latecomers to the party, I would say the party hasn't even started, and Bitcoin is good for humanity. So they take this narrative that Bitcoin is the choice of criminals, and it remains a financial product of choice among financial predators and lawbreakers, ignorant of the fact that, of course, most crime is conducted using fiat money. Why would criminals use a perfectly transparent ledger where every single Satoshi is accounted for and it's on a fully transparent ledger? Why would they use Bitcoin when they could use good old-fashioned cash and work with their banker friends? It makes you wonder. In any case, not a lot of crime is conducted using Bitcoin, especially when you compare it to fiat cash. Redistributing wealth is something that they talk about, how effectively if Bitcoin rises in value, it will rob and take wealth away from anyone that does not hold Bitcoin, which should really clue you up as to now the central banks aren't just ignoring Bitcoin, but they are now painting a narrative where they're saying it could mean that if you don't hold any, you become poor, and I might not disagree with them on that point. In any case, increasing Bitcoin prices implying a corresponding impoverishment of the rest of society, endangering cohesion, stability, and ultimately democracy itself, folks. Get really scared because the boogeyman Bitcoin is coming for you. They say it can be argued that a normal credit transfer has also no trusted third party. That makes no sense at all. If there is credit, then there is a third party providing that credit. There is counterparty risk, and this is one thing that Bitcoin has solved for. It's peer-to-peer transferable value with no intermediary, permissionless, and decentralized. And of course, central bankers hate it, and they go so far as to say that credit transfer also can have no trusted third party. I have no idea what they're talking about on that point. And of course, they gripe about Bitcoin's energy usage, and they say it can be done more efficiently otherwise, instead of proof of work, which us miners are doing to secure the Bitcoin blockchain. Insane, completely insane. Of course, they want to roll out their CBDCs, and they're on the back foot because now people are adopting Bitcoin and it's improving their lives. So they say it's inefficient to alternative ways to secure and safely prevent double spending. Wrong. It cannot be used productively and absent legal use cases. Again, what world are they living in by making these arguments? God knows. They cite Larry Fink, who is, of course, the head of BlackRock, the largest asset manager in the world, who has been coming around to Bitcoin. You love to see not only rich people adopt it, but I love to see the less financially privileged adopt this technology because I believe it can benefit everyone. Larry Fink says it's no different than what gold represented over thousands of years. He continued, what we're trying to do is offer an instrument that can store wealth. So apparently Larry Fink begs to differ from these guys writing for the ECB. They talk about pensions, and they talk about how pensions are underfunded, and some have argued that they will need to adopt Bitcoin in order to remain solvent if they have any intention of closing the massive gaps between the money they've promised and the money they actually have. They had better start allocating to Bitcoin, quoting Marty Bent. So they talk about how Bitcoin is becoming a speculative investment and complaining about how it's not so much a means of exchange. Of course, if you understand basic economics, you realize that store of value precedes medium of exchange. And yes, it is an extremely volatile asset because it is an emerging technology. It is a 0-to-1 technology. Most people have no idea what Bitcoin is, like these authors of this paper. So, citing the various asset managers such as Larry Fink of BlackRock, Cathie Wood of ARK Invest, etc., they're looking at Bitcoin as a pure investment asset, growing future valuations decoupled from economic services, drawing parallels with gold as a pure investment, assuming that society can coordinate around any asset with a finite or limited supply. Of course, Bitcoin has the most limited supply, a truly limited supply of 21 million coins to ever exist. Over 94% of those coins already exist, and miners are competing to bring the remaining less than 6% into existence following a certain supply schedule. The authors say that they do not present, they being the asset managers and people that believe in this investment thesis, they do not present or explain the reasons why society would choose Bitcoin for this purpose. Well, perhaps we're choosing this technology for the purpose because it is best fit for the purpose. I would cite the Austrian School of Economics when it comes to what are the attributes of good money. That would be durability, divisibility, portability, fungibility, scarcity, recognizability, and stability of value. Bitcoin arguably best covers these attributes of money, and it's immutable as well, so it's like gold but 1,000 times better because it is even more durable, divisible, scarce, truly finite, and it's fungible. It meets all the attributes of money. So perhaps in an answer to why we are accused of not explaining the reasons why society chooses Bitcoin for this purpose, perhaps because it is best suited for the purpose, and perhaps the market should decide. Perhaps these elitists in their ivory towers, perhaps they should allow the market to decide where value is. Bitcoin allows people to actually save money again and escape the central banker gulags of inflation. This is hilarious. They say that proponents of Bitcoin investment perspective ignore the fact that scarcity describes a relationship between supply and demand, and they say that if the demand were to disappear, the price would be zero. Genius. Of course, if demand were to disappear, price would be zero. I suppose that's true for anything, but Bitcoin is the only thing where you can have truly infinite demand over an absolutely scarce supply. Go figure. Of course, it's become a political issue, which they comment on. Of course, their solution for everything is to regulate and look to the government, big daddy, big brother government, to keep us safe. They talk about how new technologies are pivotal to growth and the increase of welfare of societies. Of course, they don't recognize any value in Bitcoin, which is redefining value in the digital age. In any case, they are measuring value in terms of GDP and other synthetic ways of measuring our wealth in society. They come up with a bunch of very goofy, in my opinion, modern monetary theory measurements. And what is so funny here is that they think that Bitcoiners are going to give away their Bitcoin and that there's going to be a balance between the haves and the have-nots when it comes to Bitcoin. I find that hilarious because it shows a complete misunderstanding of the motivation of hodling your Bitcoin. The people that are holding Bitcoin and stacking Bitcoin, the people that understand this technology, are not going to sell all of their Bitcoin for other real assets later on. Because why would you? If you own the apex asset, which is Bitcoin, why would you sell it? Of course, Bitcoiners are going to benefit from a appreciation in value of their Bitcoin, but to think that they're going to sell all of it for other assets is a complete falsehood in my viewpoint and a misunderstanding of the motivations of Bitcoiners. It talks about how central banks don't have a consensus of how to deal with their perceived bubbles that are occurring in asset classes like Bitcoin, and targeting those asset price bubbles might backfire. That's an interesting note because they're kind of a one-trick pony. Taking into account positive aggregate demand effects of a significant Bitcoin price increase. They're so afraid of Bitcoin price increasing. It's hilarious. Bitcoin takes its value only from a collective self-fulfilling belief of an increasing valuation, and there's no consensus on the policies a central bank should adopt to address these types of issues. These authors talk about a comparison of Bitcoin and religion, and saying a very diverse and mutually exclusive spiritual beliefs have existed simultaneous for centuries or even millennia, illustrating the lasting power of beliefs beyond a purely scientific logic. You see, these central bankers, all they use is purely scientific logic. Their modern monetary thesis and these fancy equations are based purely on science, like many other things that bankers and big corporations and mainstream media have fed to the gullible public. Don't think for yourselves, folks, because they're using pure logic and science. You don't want to be a fanaticist and believing in the spiritualism and the religion of a technology like Bitcoin. So, admittedly, they say any price for Bitcoin is equally plausible when you start comparing the different valuation projections. And this is really interesting because they're saying that anyone who benefits from this, any of the early adopters, are doing so exclusively at the expense of other consumers. So, folks, it's not the central bankers who have absolutely inflated your money supply massively and caused huge inflation to start pervading through the economy. It's not the central bankers. It is Bitcoin and your neighbor who has adopted Bitcoin and is sharing information with you about Bitcoin. He's an early adopter, and the inflation boogeyman is because of Bitcoiners. It's not because of the central bankers who have been printing money like no tomorrow. Give me a break. So in their models, they say we do not foresee a category of people who never hold Bitcoin, which is of course completely ridiculous because there's very small amount of Bitcoin per human being on Earth, something like 0.0025 Bitcoin per person on Earth. And of course, the massive accumulators of Bitcoin are accumulating, and likely most of that Bitcoin is going to become illiquid, such that a lot of people will, in fact, not have the opportunity to acquire Bitcoin and benefit from Bitcoin, which is why it's important, in my opinion, that you learn about Bitcoin ASAP. But their model's ridiculous, and they're assuming that eventually everyone gets some Bitcoin. Completely ridiculous assumption. So of course they come up with all these fancy equations, and they talk about how early birds are benefiting because they take a larger share of real assets, assuming that people are going to sell their Bitcoin for other assets. And they assume that the latecomers are going to buy Bitcoin from the early birds, so to say, and they're measuring the value transfer as being other assets besides Bitcoin that Bitcoiners eventually accumulate from the latecomers when they sell their Bitcoin. I find this model to be completely unrealistic. If Bitcoin prices increase steadily for good, the wealth effect on consumption of early holders, often cited as Lambo, go at the expense of consumption of the rest of the population. The wealth effects associated with it would be viewed as a zero-sum game. The redistributive effects can be significant in a long-term scenario categorized by ever-increasing Bitcoin prices. The new Lamborghini, Rolex, villa, and equity portfolios by early Bitcoin investors do not stem from an increase in the economy's production potential. Rather, they're financed by diminishing consumption and wealth of those who initially do not hold Bitcoin. It's like filling one bucket by draining water from another. This is an interesting point right there, because when it comes to Bitcoin, which is a zero-sum game insofar as we know that it is truly limited to its finite supply of 21 million. So if someone owns a Bitcoin, someone else cannot own that same Bitcoin, and there's a truly limited supply. Whereas other resources in the world are arguably unlimited. And they're saying that Bitcoin ownership has a zero-sum effect on the world's other resources. And it's interesting how they take this perspective when it comes to Bitcoin, ignoring the fact that, of course, they print billions and trillions of euros at the ECB. So when it comes to Bitcoin, they're looking at it as a zero-sum game where Bitcoiners are taking resources out of the economy due to this perceived bubble. But they're failing to appreciate the irony that the central bank literally just prints money. And that's not a zero-sum game insofar as they're able to print infinitum. And that does actually redistribute wealth from an economy where there's limited resources. It's insane to think that they don't see the irony there. And their answer is that latecomers and non-holders and their political representatives should emphasize that the idea of Bitcoin as an investment relies on redistribution at their expense. So again, Bitcoin relies on redistribution at the expense of the have-nots who don't have Bitcoin, the no-coiners who refuse to learn about Bitcoin or adopt this technology. The ECB in this paper is arguing that it comes at the expense of people that don't hold Bitcoin. And again, they fail to appreciate that their inflationary policies of printing fiat money, which they can print forever, there is no limit on the amount of euros that they can print at the ECB. They fail to savor that sweet irony that their bank is redistributing resources through the printing of money. And they're framing this argument as if Bitcoiners are the ones who are advocating for redistribution. That's really rich. So after the mind-numbing mental gymnastics that I experienced reading this paper, the distributional consequences of Bitcoin, I went to ChatGPT and I said, what are the value proposition of Bitcoin? And I like the answer because it's simple. Decentralization, it operates without a central authority like banks, like the ECB central bank, or governments, relying on a peer-to-peer network. Security, it uses blockchain technology, and I'll add proof of work for all my miners out there, making transactions secure, immutable, and resistant to fraud or tampering. Transparency, all transactions are recorded on a public ledger with basically triple entry accounting, I'll add. Ensuring accountability, there's a limited supply with a fixed hard cap of 21 million coins, and it's deflationary, which can act as a hedge against inflation, I would argue the best hedge against inflation, and financial freedom, enabling borderless, permissionless transactions, offering financial inclusion to individuals excluded from traditional banking. Boom! Take that, ECB. If you guys appreciate this content, you're interested in Bitcoin and learning more about this technology, and you're not scared about the Bitcoin boogeyman as central banks like the ECB would have you to be, then subscribe to this channel, hit sub, share this with one of your friends, or have fun staying poor. Peace out.